Hello, everyone, to our talk show, where we are going to discuss the impact of technology, fintech, and consumer perception in the future of banking. This comes from our final project for the subject fintech entrepreneurship and startup strategies. But first, I would like to introduce to our panelists. I am a blockchain developer, Karunesh. Then we have Anish as financial analyst. We have me as research and development lead. We have Heer as chief legal officer. We have Angela, who is the chief marketing officer. Sidhant as the Chief Product Manager, and Jessica as the Chief Technology Officer. First of all, I would like to take you to the history of fintech, the timeline, and the evolution of fintech. For this, I would like to first tell you what fintech actually is. Fintech describes any company that provides financial services through software or other technology and includes anything from mobile payment apps to digital identity verification to cryptocurrency. A lot of the companies that we see here are business to consumer or B2C, which means they are designed to connect consumers' finances with technology for ease of use. To give you an example, you might have heard of Robinhood, which is a US based company that facilitates commission free trades of US stocks and cryptocurrencies via mobile app. The most talked about and the most funded fintech startups share the same characteristics that are designed to be a threat and eventually take over the traditional financial service providers like big banks providing a faster and a better service. So, if we throw it far back enough, we can think of the world's first financial technologies as the development of money itself. We moved from the systems of bartering to the world's first minted coin in Lydia in 600 BC, and then in 800 BC, we see the Chinese make money move with the first evidence of cold, hard paper cash. But for time's sakes, we are going to jump forward about 2000 years to when fintech really starts picking up steam. So we are in our 1860s, the industrial revolution is in full swing, and the world's first transatlantic cable is laid down for the sending of telegraphs. And you can really think of it as a pioneer of those fiber optic cables on the ocean floor today that supply the world with hyperspeed internet. So, along with the railroad and steamships, messages start flying around the world, and towards the late 19th centuries, we turned the telegraph into a vehicle for money. Then, the post World War II era, as we start our first push towards all things cashless, ATMs replaced tellers and branches, and a magnetic strip on the back of the card revolutionized the credit card industry, and it started to really reduce the need of cash. Then, then we move into the era where fintech goes from analog to digital. We see the arrival of NASDAQ, the digital stock exchange along with BSE and SWIFT protocol for sending bank to bank and international payments. In the digital revolution of 1980s, the Bloomberg terminal is using software to pave the way for real-time financial market data analysis, and big computers were developed to provide all the processing power for all the services the bank provides again. Everything from checking accounts to investments, and we see the data that record keeping system getting more and more sophisticated. And then of course comes the dawn of the internet and e-commerce and the online banking, everything that comes along with it, specifically the smartphones. Smartphones came before 2008 financial crisis, and this brings us into the pivotal moment for fintech industry because of what happened there was lack of interest in the traditional banking system. Then we see a mass influx and tech startup with the rise of cloud and things like Amazon Web Services, which make it easier to start companies without massive capital investment into physical hardware. So right now we are in this era of fintech 3.0, and we are seeing the rise of blockchain, cryptocurrencies, emerging really shows that the power of fintech. In the internet community, fintech is a global reaching industry concept and the future. And just like in the broader tech industry, fintech is going all across the world. And in the last 5 years, emerging markets are leading in the way in terms of fintech adoption in India and China, seeing the most growth in the sector. So you see, big things are happening everywhere. So now I would like to ask my next panelist, Sidhant, about how did COVID-19 affect the banking industry and how well are the banks responding to it? Thank you.
Thanks for asking this question, Karunesh. This pandemic has challenged traditional banking models and products, changed the competitive landscape, and has served as a catalyst for digitalization. It has forced banks and their customers to use digital tools and processes to compensate for branch and call center closures. It has also caused a brawl between traditional and new banks. The new players are taking on banking-related activities and challenging existing banking models who are trying to cope up with upcoming technology. In response, banks have started to invest more in R&D for tech advancements. They are trying to understand the shift in the customer's preferences through advanced data analytics to help customize their offerings and adapt to the shifting business landscape. For economy, banks are reducing the interest rates. They are trying to buy the bonds and other debt instruments to help keep key funding markets functioning well. Some banks have started to manage people in cloud, which will become increasingly important, and for that, proper access to internet and other digital tools becomes a necessity. This brings me to the next question. How will internet access for all and easy availability of digital tools will impact the future of banking?
Well, that's an interesting question. Let me answer it. So, the digitization has swept the globe with technology and advanced analytics infiltrating every industry. As big tech and fintech companies close in banking industry faster than ever before, traditional banking have become obsolete. Banks have no choice but to embrace digital banking in a way if they want to compete. And mass digitization is no longer an option but inevitability. Digitally focused banks have benefited from market valuation that were 18% greater than average throughout the 2019 than less digitized peers and 27% higher in 2020. Technology aimed at improving retail banks' operational and efficiency is having positive impact on the market. According to Insider Intelligence, 39% retail banking executives believe the technology has the greatest impact on cost reduction, while 24% believe it has the greatest impact on customer experience. Technology has enhanced apparently every element of banking system, from retail and mobile banks to neo-banking startups. So this brings me to a question: how the shift in assessing banking services throughout mobile has an interest and internet banking and the reduction in human interaction has impacted on customer loyalty.
That's an interesting question, Meet. Banks have been moving clients away from their branches and onto digital platforms for a number of years now. Despite the widespread support for the transition to digital, the certain consumer groups prefer to visit their branch even for little transactions until the pandemic hit and changed everything. For banks, this unexpected surge in digital use is both a benefit and a problem. Although it is effective and has significantly advanced the digital agendas of most banks, the absence of human connection runs the danger of weakening the already fragile personal and emotional connection that banks currently have with their customers. This is making banking more commoditized and price driven. For instance, consumers nowadays won't even think twice before switching the banks if the other bank is providing a better and more personalized digital experience to their customers. I myself switched banks recently because of digital better services and offers the other bank was providing me. I love traveling, so the fact that Scotiabank allows me to redeem credit card points on my travel was more appealing to me, which resulted in a switch from CIBC to Scotiabank. Banks should infuse humanity and personalization into their digital channels in order to take advantage of the efficiency of digitalization while avoiding the risks it presents right now, that is, declining customer loyalty. So, this brings me to a question for Jessica, that how the role of AI and machine learning are transforming the way financial services actually work.
Sure, Anish. So there's a lot of buzz about tech companies moving to create a frictionless experiences. Tech giants such as Apple has now a credit card that tightly integrates with iPhone. Uber technology issues a debit card. The two drivers that are tied to their checking account. Facebook has introduced Facebook Pay, which is the latest online payment system that can be used across WhatsApp, Instagram, and Messenger. Looking at how AI is changing the quality of products and services, not only has it helped to handle the data, improve the customer experience, but it has also simplified, spread up, and redefined traditional processes by making them more efficient. Externally, AI is making it possible to carry out tasks faster and at a lower cost. Internally, AI is shaping companies to build relationships with their customers, other firms, and societies at large. Well, this was all from my end. So now let's ask Angela what are her thoughts about the trends and technological advancements that are shaping the future and banking and how.
Thank you so much, Jessica, for the question. Modernized technology and shifting customer expectations are the two main factors for technological revolution in banking. Here, I would like to brief you technologies that will shape the future of banking. All high-performing banks are already using hybrid clouds, robotic process automations, and API banking platforms. Although still in their inception, augmented, virtual, and mixed reality technologies are enhancing the client experiences. So nowadays, blockchain enables direct trading between individuals as well, where using a shared ledger to just keep track on the transactions. In a variety of areas such as operations and customer experiences, marketing, and any other area, banks can now use artificial intelligence to improve judgments. Prescriptive security is the best strategy for dealing with the cyber threats. It helps to minimize cyber attacks. And quantum computing is unlocking exponential computing capabilities over traditional ones. Whereas smart machines, on the other hand, are starting to serve as the customer's digital butler when interacting with banks. Now, I would like he to comment on the effect of new management or new data management and privacy laws on data handling by banks.
Thank you for such an interesting question, Angela. The laws affecting data handling and management by banks and fintech can be divided into two main categories. First, regional privacy laws. Second, internationally applicable regulations. Any fintech that needs to exist must comply with both the aforesaid categories. The synopsis of all the global privacy laws, be it PPADA or GDPR or APPI, is that they advocate for consumer awareness. With such legislations, banks and fintechs are obligated to be more transparent and disclose details of the data they collect from the consumers, the collection methodology, details on how the data is stored, tenure for which the data is preserved, details of parties who have access to the data, and the intended use of the data. And an example of mandatory compliance with global regulations would be fintechs under the payment card industry or the PCI category. They are obligated to comply with guidelines on masking of card numbers, security features such as two-factor authentication, compliance with biometrics and geolocation tags. Wrapping up, technology is dynamic and fintechs are no less. We try to predict the future in fintech, but the same is mere speculation. Only certainty is an easier life, but only time will reflect the actual costs and consequences. Thank you.